Have you ever thought the market trend is bullish and entered it by trade, but suddenly the market turns and hits your stop loss? Or even worse, the market moves exactly as you predicted, but you were on the opposite side? The problem often isn't a wrong analysis or a weak strategy. The problem is that you didn't understand the market structure properly. In this video, you're going to learn exactly what market structure means, why it's so important, and how it can turn your trading from a game of doubt and stops into a professional and confident decision. First, let's go over a general definition and understand what market structure means. Market structure is how the price moves in the form of highs and lows, and these movements tell us whether the market is rising, falling, or stuck in place. Market structure is very important because it determines the main direction of the market. And if we don't know what the market structure is, we might end up buying in the middle of a downtrend or selling during a correction and an uptrend. The market generally has three types of structures. The first structure is an uptrend. The price forms higher highs and higher lows compared to previous highs and lows. This trend shows us that buyers are in control and the market is rising. When can we say the price has formed a higher high? When a candle closes above the previous high with its body. If the price goes higher but forms a shadow and closes at or below the previous high, you should wait, and we can't say this high is valid. The second structure is a downtrend. The price forms lower highs and lower lows compared to previous highs and lows. This means sellers are dominating and the market is falling. The third structure is a range market, where the price oscillates between a horizontal high and low, with neither buyers nor sellers being strong. When can we say the market structure has changed? When the last high or low is broken, we can say the trend has changed. For example, we have an uptrend where the price forms higher highs and higher lows. If the price breaks the last low that led to the formation of a higher high, we can say the uptrend has changed. Or we have a downtrend. The price forms lower highs and lower lows compared to previous highs and lows. We can say the downtrend has changed when the price breaks the last high that led to the formation of a lower low. The high that led to the lower low is a very important point. Suppose we have a downtrend where the price forms lower highs and lower lows. As you can see, the price broke the last high, but this high didn't lead to a lower low. So it's not part of our downtrend. And we can say the downtrend is broken when the high I've identified is broken. The structure shows us where to look for trades, which trades are worth holding, and which trades are risky and should be scalped, and we can expect higher targets from them. To understand the market structure, we look at longer time frames like daily, weekly, and monthly, and we adjust our trades based on these time frames. For example, the price is in an uptrend on the daily time frame, and in lower time frames, we focus on demand zones. We enter by trades, and we can expect higher targets. But sell trades are for scalping and should be closed quickly for profit. But when the price is in a range and has no clear trend, we need to be very cautious. In such cases, we can face significant losses. Suppose the price forms a range box and moves between two levels. In the same time frame where we identified this range, the price breaks the top of this range box, pulls back, and moves in an uptrend structure. And the opposite can happen, where the range box is broken from the bottom. But there's a very important point. The price sometimes tricks traders with its movement. It collects liquidity above the box. And the trap for traders is that they think the range box is broken from the top and enter trades on pullbacks. But what happens is the price sharply drops and breaks the bottom of the box. To understand whether this breakout is fake or real, we need to learn about FTR, which I'll talk about in the future. But sometimes it happens that the price collects liquidity from both the top and the bottom, and in such cases, you need to be cautious because the price will make a very sharp move. This is very rare, but it can happen sometimes, and it's better to know about it. Now let's go to the chart and look at a few examples. Let's look at an example on the gold chart together. I'll start from recent history to see what happened. As you can see, the price made an upward move. It formed a high, then corrected and formed a low, and moved upward again. As I told you, we can say a higher high is formed when a candle closes above the previous high, and as you can see, it happened here, though it was close. Then, as you can see, the price formed a higher low and then a higher high. So far, the price has formed higher highs and higher lows, and we understand we have an uptrend structure, so we can hold part of our buy trade volume for higher targets. But here, as you can see, the price closed below the previous low, which is very important, and we can take sell trades in the price's upward moves in the existing zones. Until the price reached the zone related to this low, hit the demand zone, and made an upward move. Until the price closed above this high again, and we can be buyers again, and as you can see, the price continued its upward move. Let's go into market history and look at more examples. As you can see, the price was oscillating in a box until it managed to consolidate above this box, and the trader knows that when the price closes higher, after this rest, it can form an upward leg. An important point. Here, as you can see, the price tried to close higher, but it couldn't, formed a shadow and reversed, and in such cases, you should wait to see what happens. As you can see, the price dropped, and after a few days, it finally managed to break this high. For an example of a downtrend structure, here, as you can see, the price was in a range, then formed lower highs and lower lows until it reached our range box. If the price tries to break the last high, that led to a lower low. The trader should stay alert. And here, as you can see, the price reversed with a shadow and didn't succeed. These tips I'm giving are for the daily time frame and price movements. Even though they seem small, they are very significant. To fully grasp this, you need to practice a lot to internalize the concepts and be able to use them. I hope you'll be profitable and successful.